Hello, everyone, and welcome to BFW 2401. This is week 8, and we are talking about part 2. So if you allow me to share, so this is what I'm going to cover. And so this is week 8, and we are talking about the rest of the modeling. So this is in week 11 and week 12, as we have said, and this is continuation of, this is the continuation of what we have studied. Now, we have covered this in part 1. Now we are going to talk about in this part of the options and probability of default in multivariate and the option model. Okay, let's start. So this is the, we stopped here last time. And we are going now to talk about this part 2. Okay, it's very straightforward to talk about it. So we have talked about this before, I think, and we said if this is I, and this is K, I can calculate B, which means the 1 plus I over 1 plus K. And I think we calculated that time to be 1.10 over 1.158, and this is around 95%. Now, this is none and no problem. The problem is when we come to the multivariate. When we want to calculate not only the defaulting in the first year or the defaulting in the second year, but actually the defaulting over 2 years or maybe over 3 years, because most of the securities are having long term. So I want to see the defaulting not only in 1 year, it's not useful for me, I wanted to see it over many years. And this is why we use the multivariate. Now, the point is, it's okay. We can, if I know the, this is, for example, probability of defaulting in year 1, and I can calculate the probability of year 2, and also I can do it for year 3 and continue. And then I say, okay, the probability of defaulting of the 3 years is actually 1 minus B1 times B2 times B3. This is how I can get the probability of defaulting over 3 years. The problem is I know this one as of now, but I don't know this one and I don't know this one. So the multivariate is helping us in doing this. Now, to refresh your memory, let's go to now to year 1, for example. If I know this and this, for this example, I know this, the probability of defaulting for year 1 is 5%, which is the difference between 95%. And I can get the B1, and the defaulting of year 1 is actually 1 minus B1 minus B1, and this is 5%. I can, assuming now the B2 is 7%, then the cumulative default is 1 minus B1 times C2. If I use these numbers, I can get the probability of defaulting over 2 years of 1165, and then I can actually price or check my return. So this is how we do it over 2 years. Now, let's take another example. If the probability of payments of defaulting for 1 year is 4%, a probability of defaulting for year 2%, and I told you calculate for me the survival probability, which is the probability of payments over the 2 years, you will say it's 96%, which is actually this minus the 4%, minus the 4%, 96%, and this is 1 minus the 6%, which is 94%. And you can calculate this. So this, the probability of payment over the 2 years, or the survival probability, is 90/24. From this, I can know the cumulative default, because this is what I'm caring about. So I can calculate it is 9176%. And this is over 2 years. This is just another example. Now, let me come to here and explain what's the problem when we calculate. I want to calculate now the I2 actually, and the K2. If I know the I2 and K2, I can calculate P2. Same thing if here is the 3rd year, and this line is going here and here, and they have here K3 and I3. If I know them, if I know I3 and K3, I can calculate P3. And then, as I told you, I can calculate the probability of defaulting over the 3 years, no problem. So the way we do it, there is assumption. And the assumption is there is something called spot rate. Now, the spot rates are offered in the market. If you are an investor, something called spot rate, and something called forward rates. So the spot rate is saying, do you want to invest for 1 year? I can give you for 1 year, for example, it's 6% in the spot. Do you want to invest for 2 years, long term? This is, for example, short term. Long term, 4 years, I can give you, for example, 7.1%. What does this mean? Means in the first year, I give you 7.51%. If this is 7%, for example, sorry. If this is 7%, I can give you 7% here. I can give you 7% here for 2 years, if this is a long term. And I can give it to you now, which means now when we are negotiating in time 0. The problem is, if you are interested to invest only for 1 year, short term, and liquidate here, and invest for the 2nd year. This I know, which is now the 6%, this I don't know. So I want to know this. So actually, how can I know it? I come to something called arbitrage. If there is free arbitrage, which means no arbitraging, no arbitrage, which means it doesn't make difference whether you invest in 1 year and you liquidate here, or you invest for 2 years. Those informed investors, the information is there, and nobody can make a profit. This is what we mean by arbitrage. Nobody can make a profit between shifting between those two ones. So if somebody say, okay, I will invest in 1 year and liquidate and get the 2nd year, I may get more return and defeat these returns of 2 years. They cannot do that. The assumption is here. And therefore, if you can take the spot of long term, which is 1 plus R in year 1 for 2 years, equals actually 1 plus R for the first year, times or plus the 1 plus R or forward rate, which is 2 years. The forward year. For year 1, forward year 1, which is this one. If I can know that now, because I know this and I know this, I can know 1 plus F1 is actually 1 plus R 2 over 1 plus R1. And then I can calculate the F1 if I know this. This is the whole concept. Now I can make it for 2 years. I can make it for 3 years, but this will give me, if we are talking about the I can calculate the I, the forward for the I1, and I can calculate the forward also for the K. We have another names here, which is C and forward, but this is the whole concept, which means if you are talking about the I, you can do that. If you want to talk about the K, you can do it with the same thing. It's just, this is the most important formula that we have to understand. This is how we get the forward for year one, assuming no arbitraging. Having said that, let's go to the example. So actually, if you look at this formula, this is the forward for the K, which means actually this formula was like this: 1 plus K 2 over year 2 equals 1 plus K year 1 times 1 plus C1, which is the forward for the K. So I can get this one, actually, this formula is actually this formula. Same thing, and if I know that now, I can calculate C2. I can calculate this for the crop rate, and I can calculate it for the, this is the, I can calculate it for the crop rate, and I can calculate it for the risk-free rate. And if I can know that, then in this case, easily, I can calculate B2. Because B2 is actually 1 plus the forward rate for the risk-free plus 1 of the forward rate for the crop rate. And then if I know B1 and B2, of course, I can calculate then the probability of payment over 2 years, which will be 1 minus probability of payment of year 1, which I get it, and this one, and probability of payment of year 2, which I get it here. Probability of payment, I get it from the spot, no problem. It's just, this is, I get it from the forward rates. And therefore, now we can give an example here. So here, if you have the current required yield on 1 year and 2 years treasury bonds, this is the spot. Is 5.05 and 6%. And if I know this is for the 2 years, then I can calculate the 2 years over the 1 year, and I can calculate the forward for 1 year, and I get it. I can do that for crop rates, as I told you, if it is 10% for spot for 1 year and 13% for the spot for 2 years. This is the long term, as I told you. This is the short term. They offer me now in time 0. Then I can calculate, if I get the F1 and I calculate the C1, I can calculate actually the B2, and then I can calculate the default over the second year, or the probability of payment of the second year. This is the probability of defaulting, and I can calculate the cumulative. This is just the probability of defaulting for second year, which means the probability of payment is 92. Now, if I know year 1 and year 2, as I told you, I can calculate the probability of payment of the 2 years, which is the probability of defaulting for 2 years, probability of defaulting for 2 years, the cumulative probability of defaulting, it will be one minus B1, which is, I have it, and this is the B2, and this is the B2. This is the whole thing I want you to understand. And actually, I am done with this example. Now let's go to the next model, which is the asset pricing. This is which we call it the option model. Now the option model, it used to default. The concept is a little bit different, and I want to explain it here. The concept is there is so many companies, and this model was default after the option model, which get, you know, this Nobel Prize. Now, the issue is here. If the companies will take a loan, a firm will take a loan, and this loan will be guaranteed by its assets. And the agreement is, if the loan is defaulting, the bank can take the equity of whatever left from the equity. And therefore, we call it option because there is an exercising here. So if this is the value of the company, this is now the payoff from the shareholders' perspective. This is the shareholders who take the loan, or the company, and from the shareholders' perspective. This is the value of the company. It can be A1 or A2, and it can be this area. So this area here is the debt. So if the value of the company is 100 million, and the loan is 80 million, so the 80 million will be here. And this area will be more than the 80 million. And this area will be, this A1 will be less than the 80 million. This area, which is A2. So in this case, actually, the defaulting will happen here. And then when defaulting happened here, what will be the loss for the this option, because they give the bank the option to take the value of the company. So what is the option for them, for the shareholders? The shareholders, if the value of the company increases over the loan, their, you know, value will keep increasing. The value of this option will be very high, keep increasing as well as this guy continue. But if the value of the company goes under the debt, then in this case, what they will lose is their equity. So this is the maximum they can lose. Now, come see from the payoff of the shareholders, the bank. The bank, this is to the bondholders, debt holders. This is the shareholders, this is the debt holders, which is the lender, which is in this case, the bank. The bank, if the value of the company increase over the debt, this is the debt they give it, they will just keep, this is what they will receive, which is their principal and interest. But if the value of the company goes down, he can liquidate here or here or here or here, whatever, because this is, so this is the payoff. It depends on when they are going to liquidate the company and take over. Maybe the company will lose and they will get 0, or maybe they will get 70 million or 60 million or whatever. So actually, this is their payoff. If the company goes over A2, they have only this fixed payoff. If the company goes under that one, this is what they will get. depends on how much. If they liquidate here, they will get here, maybe here, maybe here. It depends on when they are going to liquidate. This is the whole concept. Now, this KMV, which was actually acquired by Moody's later on, come up with this model. And this model is telling you, because they provide this distribution for one company, taking in one date this loan, and they provide something called, they say, if the value of the company coming from here to here, this is not defaulting, which means the 80 million, which I was explaining, is here. The value of the company is here. When it goes under the 80 million, then this is the probability of default. If the bank, this is this distribution from the perspective of the bank, of course. If here, no problem, the defaulting will start when it goes to this area, when it is actually less than 80 million. So, having said that, they developed this model. So actually they developed something called, they calculate the H1 and the H2, which is this area and this area. And they decrease this area from this area, and they know what is the defaulting. So they can calculate now the premium. Based on this risk, they can calculate the premium. This is, as I told you, the whole thing, and this is, so they calculate H1 and H2, and I will show you how it works. So this is actually the area of the 80 million, and this is the value of the company which goes. So they come up with this model, which I don't want you to worry about it. It's just I want to tell you that this is how they calculate the premium for this such company, and this is how they value the value of the company based on this distribution. Now, as you can see, T is the time for one company to start in the same time. This is a different distribution. It's not a normal distribution. They call it EDF, which is probability frequency distribution of the assets itself for one company. And this is a different distribution for the same company. They take the asset of the company and then they calculate the probabilities. All I want to know, I don't want you to worry about all those formulas, is just we calculate what we call the premium and the value of the company, which is, this is what the bank actually cares about. Now we get the normal distribution of N, H1, and then H2. This is the value under the Z curve. Now in the exam, I will give you really NH1, and I will give you NH2. You don't have to use the tables. Having said that, let's take this example, for example. I think I have one example here. Maybe it's in the tutorial. The example is in the tutorial, which we show you how this is more explanation here, but just to give you more, you can read this explanation, which is actually what I explained, but this is very accurate model. Because if you take this model, for example, this company, this is the rating. This is the rating of Moody's. And this is the rating of S&P, and this is the rating of Moody's, and this is the EDF, expected default function. So if you can see, Moody's were saying this company, this is a real example, is B. And S&P was saying B, they only bring it to C because Bring it to C is only here in 1 February 2009. Bring it to here. This company was defaulted, of course. But all this time was considered B. Moody's were more conservative, and they take it here in 1 January 2008 and put it here. They downgraded to C, and they continue with C until it default. When they use the ADF was more accurate than the methodology of Moody's and what we call Standard and Poor. And this is, look, it was defaulted on 15 of April 2009. While these people think it's still C. And these people think it's still actually C. Both of them are saying C, triple C, while the company is already defaulting. So actually, if you follow this and you see already EDF expected them to default in this time from October 2008. And they continue with this ranking until it's actually was defaulting. So actually the option pricing was option model for is very accurate comparing to the methodologies of Standard & Poor's and Moody's. That's all. Oh, this is the example. Example will be like this. I will give you the T, I will give you the loan, I will give you the I, and the leverage and the standard deviation. All you have to calculate is the this is the calculation of here we only calculated the premium, which is actually 1.33%, and you can use the formula here to get H1 and H2, and go then get it under the N, because if you get H1 and H2, then you can get the value under the for NH1 and NH2. You can get the values. But as I told you in the exam, I will give you the values ready, and you just apply the formula and get the Q. And please understand the concept behind this one, the option pricing. This is actually all, and I'm done with this part. Thank you very much, and see you in the third one, in the third